Hello, everyone. Today on the Final Bar, I'm talking to John Kosar from Asbury Research in Chicago. We'll see what themes and charts are in his line of work as he's focusing on these markets. Choppy day today, big sort of move lower out of the open, chipping away to the upside, but the NASDAQ still down over 2%. So the S&P continuing sort of that bounce off of that 3,800 level. What's next? Is it a retest, if not a break to new lows, or further consolidation? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts, using the technical analysis toolkit to better understand what's happening around us. A choppy session today, some interesting candle patterns that have emerged actually, and some what we call long lower shadows. We'll look at some examples of stocks that have sort of had an open, traded lower, and then moving back toward the upper end of the range. Something like Meta Platforms comes to mind. What that often indicates is at the very least a short-term bounce, and that's certainly what we seem to be seeing. You're seeing buying coming in, you're seeing prices move a bit higher, but not material changes. A lot of the biggest gainers aren't really making up a ton of ground when you think about the longer-term trends. And I think that's important in this sort of environment to differentiate the short-term, that tactical time frame, which is all about mean reversion, all about how things overshoot and undershoot where they should probably be, versus the long-term trend, versus the big picture and how these trends are evolving over time. It takes a series of days and weeks, if not more, to materialize a change in trend. We have great guests on the show. I'm really excited to talk to John Kosar here in a few moments. He's one of my favorite guests because he has a great way of just making sense of this big picture using a number of different technical inputs. Just so you know, we have a couple guests next week to talk about. We'll be taking Monday the 30th off for the Memorial Day holiday. We'll be back with you on the 1st. And on June 1st, we have Dave Landry from davelandry.com. On June 2nd, we have Jay Pettit from Charts Avenue joining us from Singapore, if I remember right. So get hopefully a different take on what we're seeing from a global perspective. Let's continue on today's show. Focus on what the markets have started today, what they've done today in the form of our market recap. I do want to start with a poll, though. We always have a poll going on our Stock Charts live stream page at StockCharts.com, also on social media. So give us a follow on Twitter and check us out on YouTube as well. We asked you recently, you struggled to sell a losing position basically because of an emotional connection to that position. Which behavioral bias are you demonstrating? 61% of you, big thumbs up. You got that one correct. Endowment bias is definitely it. I actually put a video on my YouTube channel called Market Misbehavior last week, if I remember right, talking about endowment bias. That's literally where you have an emotional connection to something. And as investors, it's usually a stock or an ETF that you own. And even when the evidence tells you to get out, you still hold on to it. Has that ever happened to you? And if you're being honest with yourself and with me at this moment, you would probably say, yes, it has. That is endowment bias. It's good to think about the ways technical analysis can help you get away from that. Other biases we mentioned, confirmation bias is very much a prevalent one where we seek to confirm our preconceived idea. I'm bearish, so I look for evidence that backs up that bearish confirmation. Narrative bias is actually a really powerful one as well. We love narratives. We love thinking of a potential series of outcomes, and then we tie ourselves too much to that narrative, and it's hard for us to break away from that when the world changes, when the evidence changes. I got 17% of you with a made-up bias called selling bias. That was just me, not reality. So if you're not familiar with confirmation bias, endowment bias, narrative bias, go to our chart school page where we have all of those laid out and some of the technical tools that can help you manage them or really minimize them in your own decision-making. Continue on with our market recap. The Dow actually chipped away a nice incline through the course of the day after the initial sell-off until about 11 a.m. Eastern, finished just barely in the green, about 0.2% up from yesterday's close, sort of a V-shaped look to the Dow over the last 2 days. The S&P finishing down about 0.8%. The NASDAQ got really crushed, relative to the other two, down over 2%. So if you're looking for that big rebound in growth stocks, not today. And I would argue probably not the case given the fact that interest rates overall are in this upward trajectory. Now, we could be at that interesting point where bond prices are starting to emerge. I hope when I talk with John Kosar a little later, hopefully we'll be able to broach that topic even for a few moments. The VIX, by the way, up a little bit today, nearing that 30 level, which is a level it's been toying around with for quite some time now. Today, interest rates came off a bit. The 30-year yield actually getting back below 3% today, finishing the day around 297. 10-year yields around 276. And the TLT, good proxy for long bond prices, up about 2% today. The dollar index down 0.3%. And that stronger dollar environment has been a key story over the last 6 months or so, potentially starting to change. I'm seeing that in red a lot more than green recently. That certainly could be something to watch, particularly if you're thinking about non-US markets, which overall have been struggling in a stronger dollar environment. Gold prices as well, tough for them to do well when the dollar index is so strong. Dollar's down today, gold and silver prices higher. So GLD up 0.8%, silver prices up 1.4%. Overall, commodities essentially flat, with some of the energy-related ones down a bit today. Cryptocurrencies finding some sort of floor, although it's hard to feel really confident and excited about the charts of cryptocurrencies because so many of them have failed here to hold support recently. Just in the last 24 some hours, you see Bitcoin plunging through the 30,000 level, now settling in just above 29,000. Big round numbers tend to be important for cryptocurrencies. If you look at Bitcoin around 20,000, 30,000, 40,000, look at Ethereum around 2,000 and other major big round numbers, it tends to be an important place. And just in the last couple of days, we're seeing both of those major coins, Bitcoin and Ether, toying around with those key levels. I would certainly pay attention if and when they can get back above those levels. That has to be the first step in any sort of recovery for cryptocurrencies, which overall appear to be pretty heavy from a technical perspective. Just looking at the S&P here, I mentioned those long lower shadows, and just to give you an idea of it, if we look at this chart, I call this a candle focused chart. You know, if you follow the show, you know I usually use price bars, right? That's just from habit. In my time at Fidelity, most people were looking at price bars, and I just kind of got used to that. In my earlier days, when I was working a lot more with hedge funds and a lot more with traders, I used candlesticks much more often because working with a lot of Japanese banks, that's basically the way that they would look at the market, through candle charting, through the Ichimoku cloud and other techniques, which may or may not be familiar with you. But one of the cool things about candle charts is it really illuminates the day-to-day movements in a stock or in an ETF. If you look at the daily candles over time, it's really clear when the market's distributing. They have these big solid candles. You can see these big accumulation days, these big updates, by these big clear candles or big open candles trying to move against the longer term trend. What's happened over the last couple of weeks, we're seeing just in the last 3 days, these big, long, lower shadows. So think about what those days actually represent. 2 days ago, we opened, this was last Friday, we opened at a certain point, we trade down to around 3,800, we rally back to close more toward the upper end of the day. Today, we open at a certain level, we trade lower during the course of the day, we close back toward the top. Think of the day as being sort of a V-shaped look to the intraday chart, and that creates what's called a hammer candle, which is what you saw 2 days ago. This could actually call a dragonfly doji candle if you really want to get into the nomenclature. I tend to worry a lot less about that and just think about the dynamics. Right? You open at a certain point, you trade lower, you close back at the highs. Think about what the dynamics of that day meant. Some group of investors, some group of traders saw prices going down and got in to buy on that weakness. If that happens enough, that's a sign of accumulation. That's a sign of short-term optimism. The problem I would have with that great bullish story that I just tried to paint for you is it a short-term story? Is it telling you about a short-term bounce, which I would argue it probably is, versus a long-term story? Is this telling you a bottom is in place and obviously this is the buying opportunity of the century? That may end up being the case, but those candles are not the way that I would be able to declare that with any sort of valid technical opinion. So what we have seen is the S&P bouncing off of 3810, we'll call it. And again, that's a 38.2% retracement of March 2020 to January 2022. Myself, many others have keyed in on that level, which is encouraging. The fact that prices are bouncing off there, I am not surprised to see that. And the concern I have is if and when the S&P would get below 3,800, we start undercutting that expected level of support when investors realize that buyers are not materializing to the degree that they might have expected. That's when things can get pretty ugly pretty quickly. Now, we think about the sector returns just to finish off today's market recap. Look at what was at the top of the list. Utilities up 2%, consumer staples up 1.7%, real estate up 1.2%. How would I describe these sectors? Boring is probably not a kind way to say it, but defensive, right? I mean, these are not the sexy, juicy, everything's getting better sort of trade. This is the fetal position. I need to ride this out sort of position, right? That as an institutional investor, those are the times when you own things like utilities and REITs because you feel like you had to because other things were not presenting great opportunities there. And you need a place to get some income and just sort of ride things out. So utilities doing great. Staples, which are things like food products, tobacco stocks, which were all jumping higher today, things like PM and others, doing very nicely. What's on the downside? The FANG sectors, right? Communication services, consumer discretionary, technology. So a familiar theme to what we're seeing, while you're seeing the S&P bounce a little bit and the Dow finish in the green, I'm still seeing this as a fairly distributed market with the defensive stuff really working today. The offensive stuff, the FANG sectors, the juice, the growth names, continuing to struggle. We need to take a quick commercial break. We'll be back with my guest, John Kosar. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for our show. We're going to bring on John Kosar here in a few moments, but first, wanted to remind you, we're going to do a mailbag segment a little later in today's show, and we'd love to feature one of your questions live on the air on our next mailbag on Friday's show of this week. You can email us your questions at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. We have great, knowledgeable, expert guests, people like John Kosar and many others coming through StockCharts TV. We have special events like The Pitch, which John and others have appeared on, and so much great content for you, including our recent award-winning mini documentary on women investors on Wall Street. All of that is for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, John Kosar. John's the founder of Asbury Research based in the Chicago area. I've known John and followed his work for many, many years. And John, we need the stability of your perspective now more than ever. So thanks for coming on the show today.
Thanks for having me. It's good to be here.
So we're starting with your Asbury 6 model. I think you were back, you were on the show toward the beginning of the year, and we talked about your model is starting to rotate more to the downside. Give us an update. Where is it at now?
Sure. Since the beginning of the year, it went risk off on January the 12th, went back to risk on St. Patrick's Day, March 17th, and then it rolled back to risk off on April 12th. And Dave and I were talking off camera. It's been red all the way up and down. There's 6 different entries here. There's 6 different constituents. And outside of maybe 2 or 3 days where one of them turned green, they've all been red. And we built this thing so you don't get jerked around by the kind of market action that we've been seeing lately. The S&P is up 100 one day, it's down 100 the next. You don't know when, to really start to bite on these rallies, if you should pay attention to them, if you should keep your hands to yourself and keep them off the keyboard and don't buy anything. So really, this has helped quite a bit in a lie detector test, I guess, if you will. So it's showing me the market is internally weak right now. Until that changes, every time the market has a wild rally, I'm always looking at it with kind of a jaded eye.
One of my former analysts at Fidelity used to call charts the truth serum for the markets. I feel like your Asbury 6 model is a great example of the value of that. Can you just briefly take a minute and, what would you need to see here that would suggest to you that conditions are improving? Is it a certain number of these metrics turning more positive? Is it a particular level on the S&P? What would you need to see?
These, except for the rate of change in the S&P 500, which is the one on top, the other five have nothing to do, or they're secondary indicators, let's call them. I did it for the purpose of trying to avoid chasing my tail with the S&P 500. So four of those six, and we have relative performance, investor asset flows, corporate bond spreads, volume, breadth. Four of those six would have to turn back to green in order to give this a signal back to positive or risk on. And then just kind of as an aside, watch the VIX. The VIX says 24 for us in the VIX is kind of the line of demarcation between an opportunity to buy a dip or being in a sustainable downtrend. And the VIX has been above 24, probably for 6 weeks. So I'd like to see the VIX get down to 24, stay there underneath 24. And then, of course, if our Asbury 6 goes 4 green, that would be the signal for me to start moving money back into the market.
So still sort of a risk-off feel. Now, speaking of risk-off, we'll look at this company. I'm sure people are familiar with Tesla. What's the technical take on this name here?
The reason I picked Tesla, it's the 5th biggest stock, 5th largest in terms of market cap. And we did a test on this, and the linear correlation between Tesla and the S&P 500 has been tight and stable throughout the past 10 years. Actually, the loosest correlation has been the last 3 months, and that's been 0.71. Otherwise, they've been the high 7s and low 8s, so they move together. So we broke out of this chart pattern. It's a symmetrical triangle for those who look at this. So you had the market sideways, or you had this particular stock sideways for about 6 months, trying to hold the 200-day there in orange, really couldn't do it. And when we finally broke down, that suggested to me people have an idea on this again. They're not staying between the lines anymore. They're starting to sell Tesla. I know it has a relationship with the S&P 500, and it has a lot of weight behind it because it's the 5th largest stock. So then if you look at the bottom, we've got the relative performance chart in blue, daily versus SPY, and the 63-day overlay of the green is a 63-day average, 63-day moving average. The reason I use 63 days is it's a business quarter, lets me know what the quarterly trend of relative performance is. And since May the 5th, which was about a week before we broke down upstairs from the triangle pattern, so now I had a relative performance breakdown, and then shortly thereafter, I had the actual breakdown in the stock. So that was another reason for me not to get too antsy to buy one of these rallies in the S&P 500, because we have a very influential stock that actually points to a move down to 540. Whether we hit it or not, I don't know, but that's about 17% underneath where Tesla is trading right now.
So we only have about 30 seconds left, John, but as you're looking at this market, obviously a lot of uncertainty, elevated volatility, as you alluded to. Do you go defensive in this sort of environment? Do you own something like utilities or staples, which are pretty defense, or do you go into things like energy, which have been outperforming so much?
Well, we have another model called SEAF, it's Sector ETF Asset Flows. That has been overweight energy since Jan 10, and and we all know energy, I think it's outperformed by 60% since then. And the other one that it's been involved in is XLV, healthcare. Healthcare has outperformed since 314. I think it's outperformed by 7%. So those are the two that we're currently in. So we're trying to follow the money in the sector space. And at least while the market's going down, we're staying in the places where the money's going. And right now it's energy and healthcare.
Great take. Some of those healthcare names starting to bounce just a little bit as well. John, it's great to see you. Thanks for joining us from Chicago. Stay safe there. We'll talk to you again soon.
Thanks for having me. See you next time.
That's John Kosar. John's the founder of Asbury Research. And again, thinking back to our conversation back in January, we talked about his Asbury 6 model rotating to more of a defensive posturing, really a great take on this environment, which I would certainly describe as defensive here. And it's interesting, as John was talking about those charts, and I'm looking at the chart of Tesla, so many clear signs of stocks, instead of holding support, breaking down. I tell you, I would start getting excited when that stops happening, right? When you have things given the opportunity to break down, they don't do it. We're not seeing that yet. We're seeing names that are continuing to fail at support. Great take there from John Kosar at Asbury Research. Let's continue on today's show with our final bar mailbag. As a reminder, our email is thefinalbar@stockcharts.com. Keep your great questions coming, and let's get to question number 1. I have heard, I love this question so much. I have heard that there's a secret candle when institutions invest or divest. My husband and I would like to know if this is true. And if so, can you show us an example? And what I love by this question, this is a representative of a number of questions I've got. I would call it very conspiracy theory. I get a lot of questions on who's gaming this, who's profiting, who's got this all figured out. I will be honest, having been on the institutional side, these are challenging periods. It's way more fun to figure things out when everything's kind of working and when things make sense. No one enjoys, regardless of what you're doing, when something you are responsible for is bright red and going down. It's not particularly fun. So is there a particular candle pattern? No, I will tell you the candle patterns that I have seen, having spent a lot of time on trading desks with investors, the ones that are most common are some of the ones that we'll talk about here. Hammer candles, which are great indications of a potential bottom, because that shows you in the short term that traders are coming in. And often that can be a good indication of the next one or two price bars at most. But that's a good one. Bullish and bearish engulfing patterns are very widely pointed out. And again, just knowing my peers in the industry, we all sort of compare notes on those types of things. So are there popular ones that I think people look at? Absolutely. Are there secret candles? No, is the way I would answer that. But I would encourage you to check out on our chart school page. We have illustrations of all those different candle patterns. And I would really think about the risk management part. A lot of things like hammer candles and engulfing patterns actually have a built-in risk management piece to it. And I would encourage you to make sure that that's part of your thinking on candlestick analysis. Next question. Today, you talked about impulse waves up during bull markets and down during bear markets and counter trend moves. Who is doing the buying and selling during counter trend moves? Do you have a way of thinking about that? It's a really thoughtful question. That could be a whole hour webcast on just answering that. And let's look at a chart of the S&P 500. And what I'll do is I'll bring in volume. I usually don't have volume on my charts, but I will add it on here. So we say volume overlay. What this is going to do is just pop the volume in here and we color code it as well. So what we're talking about, right, is the underlying trend in the market has been down, right? It's been up, going into the end of last year. It's been down in 2022 with some notable exceptions. Mid-March is an example of where the market really rallied, but overall the trend has been lower. So you have this series, particularly in the last 6 weeks, of a downtrend. The impulse moves are down, and then you have these sort of counter trend rallies, right? These short-term, very quick rallies that go to the upside. One of the things you want to look for is the volume on those counter trend moves. What's concerning is when you have a big, or not concerning, but what sort of validates the downward thesis is the down days see heavy volume as there's a lot of selling going on and not a lot of buyers coming in. The big up days have a lot less volume. And if you look here, I'm seeing a lot of big red volume bars, and the green bars, the green volume days, are a lot lower. What that in general would suggest is that sort of counter trend environment where the impulse move is going down. You have the big distribution days, you have accumulation, but the volume is not great. The other thing you would look for is breadth, right? What's the breadth on those up days, right? So the market can be up 3-4%, but if the breadth is like 50-50, that means that only half of the stocks are actually pushing things higher. It is not a broad advance with everything going higher. And that in general is how I would summarize a lot of those moves. So those are some of the ways that I would think about it. And what that generally tends to represent, lower volume tends to indicate more retail investors, just because big institutions are the ones that command tons of volume, right? If you're running a $10 billion fund and you're unloading a position in Disney, you are unloading thousands and hundreds of thousands of shares, because that's how much you need to have the exposure in your fund. If you're a retail investor selling, 100 shares of Disney, it's not going to be a blip on the price chart. So, in general, when you're following volume, you're trying to follow the big institutions and what they are generally doing. And so that's what. So who is actually doing those buyers? In general, in this sort of phase, it tends to be aggressive retail investors, speculators trying to pick a bottom. And I will tell you, having gone through a lot of bear market phases, trying to pick the bottom day to day, in many ways is a fool's errand. It's great to look back and say you did it. It is really tough, and it's not probably worth your capital or your effort to try to pinpoint it. I always have found wait until the bottom is confirmed. John Kosar earlier mentioned his Asbury 6 model, 4 of the 6 turning positive. That would have to be quite an improvement in the trend before that would resonate and register a buy signal. That's what I would probably be looking for here. Next question. I'm wondering why you never comment on options expiration days like today, market manipulation and market makers. Is it possible we saw the rise at the end of the day due to manipulation by market makers because of options expiration? It makes me wonder if you still have relationships with market makers. I love this. Or maybe you signed an NDA or something like that. So I'm sure I signed plenty of NDAs, but it had nothing to do with options expiration and market manipulation. That's not something you are willing to do, and then you have to sign an NDA to not do it. We have ethical standards that govern my time, and I'm happy to tell you I did nothing, manipulative in any of my career for sure. That's actually part of having a CMT or a CFA designation. Is you have to agree to abide by ethical standards that include things like front running your clients, making sure that you do things for your clients before your own personal benefit, disclosing your holdings. These are all things that we agree to do as professionals, and that is why the people that come through, like John and others that have a CMT, and myself, which one of the things I like about it is we've all agreed as a group of specialists, group of experts, to abide by those ethical standards. Having said that, what is there market manipulation? No, and I know that there are YouTube channels that really love to promote that is something that's going on. Having said, options expiration really is a thing, right? And there are a lot of things that have to happen. I would say a lot of what you're seeing is most likely less market manipulation. That something like that could be going on, I'm sure, but not anything I would be privy to. But I think more often than not, it's the natural rotation, right? When futures or when options expire and you still want to have a bet on, you immediately have to unwind a ton of positions and take on a bunch of positions. It's a thing. And so you'd always have to plan ahead on how you're going to do that, how you're going to balance it, how you're actually going to make the trades. And that causes a lot of additional volume, that causes a lot of additional volatility, just because that I would guess most of what you're seeing is more of the natural rhythm of the markets. The reason why I don't tend to mention it, and I made a note to point this out a lot more often, I learned, again, it's probably from working with longer term investors, you worry less about that, which is really the dynamic of one day. I'm worrying more about the trend, and the options expiration dates a lot of times are more noise than anything. You wait to see what happens coming out of that. Once the bets are now in place, what is the trend that's happening after that? I would argue that is way more important than what happens on a particular Friday, which you call a triple witching or a quad witching day. But I will make a point to refer to those more often to keep you guys informed. That's all we have for the mailbag. Keep your questions coming, and thank you guys so much as always. But we need to wrap the show. We need to go to the 3 and 3. Let's go through 3 charts in 3 minutes that tell the story of this market environment. Chart number 1 is the S&P 500 using candlestick analysis. I don't use candles a ton on this show, only because they tend to be a little more short-term, right? Candlestick analysis by definition is a short-term dynamic. And you can look at weekly candles and even monthly candles if you want. It's less common. I mean, most investors, most traders that use candlesticks are using daily candles because that is a clearly defined open and close. It's really how the discipline has proliferated around the industry. I'm noticing on the S&P, what you have these long lower shadows. There's actually a pattern called a tweezer bottom, which is when you have 2 days in a row with these long lower shadows. You're not necessarily seeing that here, but when you have a bunch of long lower shadows as a chart is hitting potential support, that tells me something. That tells me that buyers are certainly coming in, and that's how the market is stabilizing. What it also tells me is if we break the low of that day, that's last Friday's candle, that is something to certainly be wary of. Chart number 2 is the utilities sector. When I'm thinking about relative strength, in yesterday's show, we were looking at the relative rotation graph, the RRG, and how the sectors were rotating. You're seeing a lot of strength on a day like today from defensive areas of the market, like real estate, like consumer staples, charts like PM and others, and also utilities. You're seeing the XLU up 2%, while the NASDAQ's down over 2%. This tells the story of 2022 in one little nugget of information, right? Defensive stuff working just fine. Offensive stuff struggling. The growthy stuff is really struggling. Look at the relative strength on the utilities sector from last November to today for the last 6 months. This has been a fantastic sector to own, and I don't see that changing yet based purely on the relative strength there. Finally, a lot of stocks breaking down. I like John Kosar's take on charts like Tesla, which instead of holding at support, they broke down. RCL and some of the other cruise lines are really testing those support levels now. If you look at March 2020 on RCL to the February 2021 high, look at how these Fibonacci levels have served very important roles. We are currently right at that 61.8% level, which is just above 49.70. Can it hold that? I'm doubtful. Folks, that is our show for today. I want to thank you so much for joining us every weekday after the close. Special thank you to John Kosar from Asbury Research. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.